Why smart people make bad investments. The psychology behind your stock picks. Have you ever watched your portfolio drop 20% and felt your stomach turn? Or held onto a losing stock way too long, hoping it would bounce back? Maybe you've sold a winner too early, only to watch it double in the next 6 months while you sat on the sidelines. You're not alone. And here's what might surprise you. Your education, intelligence, or financial knowledge probably won't save you from these mistakes. Here's the uncomfortable truth. Your brain wasn't designed for investing. Evolution prepared us for surviving on the savannah, not navigating stock markets. Our ancestors needed quick reactions to immediate threats, not patient, long-term thinking about compound returns. And that mismatch between our evolutionary wiring and modern markets costs investors billions every year. A study by Dalbar Inc. found that over a 20-year period, the average equity investor earned just 5.9% annually, while the S&P 500 returned 9.9%. That's a massive gap, and psychology explains most of it. Today, we're diving deep into the psychological patterns that sabotage even intelligent investors, and more importantly, what you can do about it. Let's get started. Chapter 1. Loss Aversion. Why losses hurt twice as much. Quick takeaway. Losses feel twice as painful as gains feel good, and this ruins your strategy. Imagine two scenarios. In the first, you gain $1,000. In the second, you lose $1,000. Which one affects you more emotionally? If you're like most people, the loss stings far worse than the gain feels good. This is called loss aversion, first documented by psychologists Daniel Kahneman and Amos Tversky in their groundbreaking prospect theory. Their research showed that losses are psychologically about twice as powerful as equivalent gains. Kahneman eventually won the Nobel Prize in economics for this work. This isn't just theory, it fundamentally changes how we invest. Loss aversion makes us hold losing stocks too long, hoping to get back to even. We tell ourselves, it's not a real loss until I sell. This mental accounting trick feels comforting, but it's economically meaningless. Markets don't care about your purchase price. A bad investment stays bad whether you sell it or not. Every day you hold it, you're choosing it over all other investments. Think about it this way. If you wouldn't buy that stock today at its current price, why are you holding it? Usually, it's because selling would force you to acknowledge the loss. That psychological pain is so intense that we'd rather hold and hope than accept reality. On the flip side, loss aversion makes us sell winners too early. We lock in gains because we're terrified of watching profits disappear. I'm up 30%. Better take it before it evaporates. But this means we cap our upside while letting our losers run. Exactly the opposite of what successful investing requires. The old Wall Street wisdom is cut your losses short and let your winners run. Loss aversion makes us do the reverse. The data backs this up powerfully. Studies of retail investor accounts show people hold losing positions 124% longer than winning positions on average. Some research shows it's even worse. Losing stocks are held up to 165% longer. That's loss aversion in action, and it's destroying returns. There's also a phenomenon called the disposition effect. Our tendency to sell assets that have increased in value while keeping assets that have dropped in value. Terence Odian's research at UC Berkeley found that stocks investors sold out performed the ones they kept by 3.4% over the following year. We're literally selling our best performers and keeping our worst. The solution? Many successful investors use automatic stop losses or rules-based selling to remove emotion from the equation. If you decide in advance when you'll sell, both on the upside and downside, you can override loss aversion before it kicks in. Chapter 2. Confirmation Bias. Seeing what you want to see. Quick takeaway. We seek information that confirms what we already believe, creating dangerous blind spots. You've done your research and bought shares in a promising tech company. You analyze the financials, read the earnings reports, and you're convinced it's a winner. Now, when you read news about that company, what happens? You probably notice every positive article and dismiss the negative ones as missing the bigger picture, or written by people who don't understand the technology. This is confirmation bias, our tendency to search for, interpret, and remember information that confirms our existing beliefs while ignoring or discounting information that contradicts them. In investing, it's particularly dangerous because it prevents us from seeing when we're wrong until it's too late. When we own a stock, we unconsciously become cheerleaders for it. We have a personal stake, both financial and psychological, in being right. So we follow optimistic analysts, join enthusiastic Reddit threads or Discord groups, and rationalize away red flags. Meanwhile, we ignore or downplay contradictory evidence, dismissing bearish analysts as shorts or pessimists. Research from the University of California found that investors selectively expose themselves to information that supports their existing positions. They literally avoid reading analyses that challenge their investment thesis. Some even stop following analysts who issue downgrades on their holdings. This creates echo chambers around our portfolio choices. We surround ourselves with people who agree with us, reinforcing our conviction even as the fundamentals deteriorate. Online investing communities can make this worse. Algorithms show us more of what we already engage with, creating an information bubble. There's also a related phenomenon called belief perseverance, where we maintain our beliefs even after the evidence supporting them has been completely refuted. In investing, this means holding on to a thesis long after the market has clearly moved on or the company's situation has fundamentally changed. Here's a real example. Many investors held blockbuster stock well into the Netflix era, convinced that people would always want physical stores. The evidence was everywhere that the market was shifting, but confirmation bias kept them from seeing it. The same pattern repeated with Kodak during the digital camera revolution, with taxi medallion owners during the Uber disruption, and countless other examples. The most successful investors actively fight this. They seek out opposing viewpoints and seriously consider the bear case for their holdings. Warren Buffett famously says he looks for reasons not to invest in something, not reasons to justify a decision he's already made emotionally. Charlie Munger takes it further, saying he can't have an opinion on something unless he can argue the other side better than people who hold that view. Ray Dalio, founder of Bridgewater Associates, built his entire investment process around this idea. He calls it thoughtful disagreement and actively encourages his team to challenge each other's assumptions. His firm's success suggests this approach works. Chapter 3. Herd Mentality. Following the crowd off a cliff. Quick takeaway: what everyone else is doing feels safe, but it's often expensive. When GameStop rocketed from $20 to $480 in January 2021, millions of investors piled in. Not because of fundamentals, the company was struggling with declining revenues, but because everyone else was doing it. Social media was flooded with success stories, CNBC covered it 24/7, and friends were making money. That's herd mentality, and it's one of the most expensive psychological patterns in markets. This isn't new. From the Dutch tulip mania in the 1600s, where single tulip bulbs sold for the price of a house, to the South Sea bubble, the dot-com bubble, the housing bubble, and the cryptocurrency craze, history repeats the same story with different assets. When everyone around us is making money, we feel left out. The fear of missing out, FOMO, becomes overwhelming. There's a deep evolutionary reason for this. For most of human history, going against the group could get you killed. If everyone in your tribe said, "Don't go in that cave," ignoring them was dangerous. Our brains are wired to follow the crowd for safety, but what kept us alive on the savannah doesn't work in markets. Studies show that social proof is one of the most powerful psychological forces in finance. We assume that if millions of people are buying something, they must know something we don't. We think the crowd is wise, but crowds aren't wise in markets. They're emotional. Individual investors can be rational, but put them together and you get manias and panics. Here's why this matters for your returns. Herd behavior pushes prices far above fundamental value. When you buy what's popular, you're often buying at the peak. Professional investors call this buying at the top. And when the herd panics and sells, you're selling at the bottom. You're buying expensive and selling cheap. The numbers are stark. The Vanguard Group analyzed investor behavior during the 2008 financial crisis. Investors who followed the herd and sold stocks near the bottom in March 2009 missed the entire recovery. The S&P 500 went on to gain 400% over the next decade. Those who stayed disciplined or bought during the panic earned exceptional returns. Research also shows that individual investors tend to buy high and sell low systematically. They pile into mutual funds after strong performance and withdraw after poor performance. Morningstar tracks something called investor returns, what actual investors earn, versus total returns, what they would earn if they just bought and held. The gap is usually 1 to 2% per year, entirely due to bad timing driven by herd behavior. There's also a professional version of this called institutional herding. Even money managers who should know better pile into the same trades. They do this partly for career safety. If everyone owns the same stocks and they all go down, you won't get fired. But if you own something different and it goes down, you're out. As Keynes said, it's better for reputation to fail conventionally than to succeed unconventionally. The uncomfortable reality is that making money in markets often means doing the opposite of what feels natural and what everyone around you is doing. When everyone's greedy, be fearful. When everyone's fearful, be greedy. Buffett's famous advice is simple to understand, but incredibly hard to follow. Chapter 4. Recency Bias. The last chapter isn't the whole story. Quick takeaway: recent events dominate our expectations about the future, blinding us to cycles. It's 2021, and tech stocks have soared for over a decade. An investor looks at their portfolio and thinks, tech always goes up. The pandemic proved that technology is the future. I should put everything in tech stocks. They load up on high-growth companies with sky-high valuations. By 2022, that investor has lost 40 to 60% as interest rates rise and tech crashes. This is recency bias, our tendency to weigh recent events more heavily than historical patterns. What happened yesterday feels more important than what happened years ago, even when the longer-term data is more relevant. After a bull market, we become convinced that high returns are normal. The market returned 20% last year, so I'm planning for 20% this year. After a crash, we're certain the market will never recover. I lost half my money in 2008. I'm never investing in stocks again. Both feelings are wrong, but they're incredibly powerful in the moment. This bias affects everything from asset allocation to individual stock picks. After cryptocurrency boomed in 2017, everyone wanted crypto exposure in 2018, right before the crash. After real estate soared in 2005 to 2006, people thought home prices never go down. Right before they did, dramatically. Morningstar data shows a clear pattern. Investors pour money into funds after they've performed well and withdraw money after they've performed poorly. Fund flows follow performance with about a one-year lag. They're constantly buying high and selling low, driven by recency bias. This fund was the best performer last year, becomes the primary selection criterion, even though past performance explicitly doesn't guarantee future results. This also affects how we construct portfolios. After 2008, many investors avoided stocks entirely, moving to safe bonds and cash. They missed the longest bull market in history because recent pain was too fresh. After the tech boom of the late 1990s, people piled into tech funds in 2000, right at the peak, because the recent returns were so attractive. There's also something called the hot hand fallacy in investing. If a fund manager or strategy has been winning, we assume they'll keep winning, like a basketball player with a hot hand. But academic research shows that past performance in active management is barely predictive of future performance, yet we can't help but chase last year's winners. The antidote is perspective and understanding market cycles. Markets move in cycles. No trend continues forever. Bull markets eventually end. Bear markets eventually recover. Understanding that recent performance, good or bad, is temporary helps you avoid making emotional decisions at exactly the wrong time. Historical data matters more than recent data. Over rolling 20-year periods, the S&P 500 has never lost money when you include dividends and adjust for inflation. But in any given year, it can be up 30% or down 30%. In any given month, anything can happen. Recent results aren't predictive. They're just the most emotionally salient because they're fresh in our memory. Professional investors often use tools like moving averages and long-term trend analysis specifically to counteract recency bias. They force themselves to look at longer time frames to see the bigger picture. Chapter 5. Overconfidence. Your biggest enemy in the mirror. Quick takeaway: most investors think they're above average. Most are wrong, and this costs them dearly. Here's an uncomfortable statistic. Studies show that 70 to 80% of investors believe they'll outperform the market average. Some studies put it even higher. One survey found 93% of drivers think they're better than average at driving. But by definition, 80% can't be above average. This is overconfidence, and it's perhaps the most expensive psychological trap of all. Overconfidence shows up in multiple ways in investing. First, it makes us trade too much. We think we can time the market, pick the perfect entry point, or spot trends before others. We see patterns in random price movements. We believe we have insights that the market hasn't priced in yet. But the data is brutal. Brad Barber and Terence Odeon's landmark study analyzed 66,000 households over 5 years. They found that the most active traders, those acting on their confident hunches, underperformed the least active traders by over 6% annually. The most active 20% of traders earned annual returns of 11.4%, while the market returned 17.9%. That's a devastating gap. Why? Trading costs money in fees, commissions, and spreads. More importantly, frequent trading is usually driven by emotion, overconfidence, and false pattern recognition, not by genuine insight. Every trade is an implicit statement. I know better than the person on the other side of this trade. Sometimes you're right. Often you're not. The study found men trade 45% more than women and underperform by 2.65% annually as a result. Single men trade even more and underperform even worse. The reason? Overconfidence. Men on average display more overconfidence than women in domains like investing. The more confident you feel, the more you trade. The more you trade, the worse you do. Overconfidence also makes us under-diversify. We put too much money in a few stocks we're certain about. I work in tech, so I know this company will dominate. Then that company misses earnings and drops 30% in a day, and suddenly a huge chunk of your portfolio is gone. Professional investors know that even thorough research doesn't eliminate risk. That's why diversification matters, even when you feel confident. There's also something called hindsight bias that feeds overconfidence. After something happens, we feel like we knew it all along. I knew that stock would crash. But when we look back at what we actually said before it happened, we weren't nearly as certain. This hindsight bias makes us overestimate our predictive abilities, which leads to more overconfidence in the future. Another manifestation is thinking you can beat professional investors. Thousands of highly educated, well-resourced analysts spend 80 hours a week analyzing companies. They have access to better data, better models, and instant execution. And most of them still can't beat the index consistently. Yet individual investors often think they can do it in their spare time with free tools. That's overconfidence. The truly successful investors are often the most humble. Warren Buffett draws a circle of competence and stays within it. He admits what he doesn't understand and avoids it. Ray Dalio titled his book Principles because he believes in following systems, not hunches. They know that markets are complex, unpredictable, and full of smart competition. They focus on process, not predictions. They diversify because they admit what they don't know. Consider index funds and ETFs. They require admitting you probably won't beat the market by picking individual stocks. That admission feels like failure to our overconfident brains. We want to believe we're special, that we can see what others miss. But study after study shows that passive index investing outperforms most active investors over time, especially after fees. The evidence is overwhelming. Over 85% of actively managed funds underperform their benchmark index over 15-year periods. If professional fund managers with teams of analysts can't consistently beat the market, what makes us think we can? The solution isn't to never pick stocks or never be confident. It's to calibrate your confidence to reality. Be confident in your process, but humble about your predictions. Diversify. Don't bet everything on being right. Build in margin for error. And track your actual results honestly. You might be surprised at how your perceived skill compares to your actual performance. Chapter 6. Anchoring. When first impressions trap you. Quick takeaway. We fixate on the first number we see, even when it's irrelevant. You bought a stock at $100 per share. It drops to $60. Now every time you check the price, you compare it to that $100 anchor. It's still down 40% from where I bought it. The $100 feels meaningful, like it's the real price, and $60 is temporary. But here's the truth. The market doesn't care what you paid. That $100 is just a number, your personal anchor. To the market, the only relevant question is, what's this company worth today? This is anchoring bias, our tendency to rely too heavily on the first piece of information we receive. In real estate, the listing price becomes an anchor. In salary negotiations, whoever mentions a number first sets the anchor. In investing, our purchase price becomes an anchor that distorts all future decisions. Anchoring makes us wait to sell losers until they get back to even. We anchor to our purchase price, and that $100 feels like the target we need to hit before we can sell. But this is completely arbitrary. If the company's fundamentals have deteriorated, it might never reach $100 again. Meanwhile, you could invest that $60 elsewhere. It also works in reverse. If you're watching a stock and it rises from $50 to $150, you anchor to that $50. When it pulls back to $100, you think, oh, it's on sale. It was $150 just last month. But maybe $100 is expensive. Maybe it was overvalued at $150. Your anchor is misleading you. Research shows that even random numbers can create anchoring effects. In one study, showing people arbitrary numbers before asking them to estimate a stock's value affected their estimates. Our brains grab onto numbers and use them as reference points, even when we know they're meaningless. The solution is to regularly reassess investments based on current value, not past prices. Ask yourself, if I didn't already own this, would I buy it today at this price? If the answer is no, that's a signal your anchor might be trapping you. Summary. So what have we learned? Your psychology might be the single biggest factor determining your investment results, bigger than intelligence, education, or how many hours you spend researching. Loss aversion makes you hold losers too long and sell winners too early, exactly backward from what works. Confirmation bias blinds you to warning signs in your portfolio, keeping you in bad investments while the evidence mounts against them. Herd mentality pushes you to buy high when everyone's excited and sell low when everyone's panicking. Recency bias makes you overreact to recent events and chase performance. Overconfidence leads you to trade too much, diversify too little, and overestimate your ability to beat professional investors. And anchoring traps you in irrelevant reference points. These aren't character flaws. They're features of how human brains work. We all have them. The difference between successful and unsuccessful investors isn't whether they feel these impulses. It's whether they have systems in place to counteract them. The good news? Awareness is the first step to better results. When you feel the urge to make an impulsive trade, pause and ask, which psychological trap am I falling into right now? Is this loss aversion talking? Am I following the herd? Am I overconfident? The most successful investors aren't the smartest. They're the most disciplined. They have strategies that protect them from their own psychology, whether it's automatic rebalancing, diversified ETFs, rules about when they'll sell, or simply keeping an investing journal to catch their own biases. They build guardrails against emotional decisions. Some practical steps. Write down your investment thesis before you buy, so you can check if it's still valid later without confirmation bias. Set rules for when you'll sell, both on the upside and downside, to counteract loss aversion. Diversify broadly to protect against overconfidence. Focus on long-term fundamentals rather than recent performance to fight recency bias. And consider index funds as the core of your portfolio, Sometimes the best way to beat your psychology is to stop trying to beat the market. Remember, your brain is working exactly as evolution designed it. It's just not designed for investing. But once you understand your psychological blind spots, you can work around them. And that might be the edge you've been looking for. Share your thoughts on psychology's impact on investments in the comments. If you would like to receive more content like this, or if you would like to help others find this channel, please subscribe.